Christine, why don't we start?
Sure, that sounds great. All right, everyone. Hello. Thank you so much for joining our webinar today. My name is Christine, and I will be your moderator today. ERISA attorney Larry Grugine is our presenter. If you missed something, don't worry. We'll be emailing you a recording of the slides after the webinar concludes. I'll be keeping the webinar muted to avoid any background noise. We'll stop at the end for questions. Just type your question in the box below and I'll read it aloud for you. Okay, Larry, I'll hand it off to you now.
Thank you very much. During this seminar, we're going to be talking about these areas that you see in the slide. We're going to be talking about allowable election changes, the carryover rules, as some of you may have carryover provisions in your plan. We're going to be talking about how health FSAs intersect with Cobra. And then we're also going to see how HRAs and FSAs and HSAs and FSAs kind of work together and what are the rules in regard to that. And then we're going to do a what if. We never know when healthcare reform is going to be changed or amended or done away with. So we're going to do for a few minutes a what if. What if everything went away? How would FSAs look? And lastly, we're going to look at dealing with mistakes, common mistakes that many employers and many TPAs are confronted with, and how is the best way to deal with those mistakes. We're going to be talking about that. Now, what we're going to be talking about today is health FSAs. How do they work? Some issues in regard to this, and that's what we're going to be talking about today. First of all, we're going to be talking about allowable election changes for health FSAs. One thing is important, that the regulations allow for cafeteria plans around 13 or 14 different qualifying events to allow individuals to change their elections under the basic cafeteria plan or the POP plan. The problem that many employers don't understand, only about 5 of those qualifying events actually apply to health FSAs. And one thing you're going to see when you look at this list is the fact that it doesn't include changes because of cost of coverage. And one of the biggest issues that employers face, if your health plan, group health plan if their plan year is different than the health FSA, and you make a change during the year where you're changing from for example, a PPO to a high deductible plan. In that situation, you can't allow an individual that changed their election under a health FSA to either reduce it or to eliminate it, because as you're going to see in a few minutes, that change, cost and coverage, is not one of the changes that you see there. So generally, employers, there's a general irrevocable rule that says that no change is required for the plan year. So as an employer, you can say, you know, once you make an election before the beginning of the year, it has to remain until the end of the year. Well, that's not realistic because people have different things going on in their lives. So employers have to allow them to make changes during the year. So there's 5 events that are recognized by the IRS as permitting mid-year changes. And then I'll be talking about other events that you may recognize as an employer, for example, mistakes. And then what you have to do in order to administratively take care of those changes and implement them. Now, these are the 5 events, as I indicated, that you can allow an employee, if you want, you can pick any of the 5, all the 5, it's up to you. But these are the different changes if they happen to the employee, they can change their election. And they're eliminated, increase it, decrease it. But these are the events. So let's look at the events. There's change in status, marriage, divorce, having a child, Cobra qualifying event. Somebody qualifies for Cobra, of course, they can eliminate their health FSA election or reduce it. Judgments, decrees, and orders. This is a quadro situation. entitlement to Medicare and Medicaid. You can allow them to change their election for that purpose, but also family and medical leave. And these are important life events. You can allow an individual to change their FSA election. So what are the changes that are allowed under change in status? Well, if change in employee's marital status, either a marriage or divorce, change in number of dependents, change in employment status. For example, in this situation, somebody that now, because they go from part-time to full-time, or full-time to part-time, that affects the underlying coverage. And that situation, because of the employment status change, you can allow them to change their election. Dependent satisfying or ceasing to satisfy dependent eligibility requirements. If that person, if they get a new dependent or a dependent changes 26, then you can reduce your election under the cafeteria plan or under the health FSA. Change in residence. Because of the fact that you moved and now you're eligible for either no health coverage or a different health coverage that affects you, then you can change your election. And then commencement or termination of adoption proceedings. These are events that you can, as an employer, you can allow an employer to change their election. So let's look at change in status. Change in status includes marriage, divorce, death of spouse, legal separation, annulment. Now, the most common question I get in this situation, suppose somebody files for a divorce. Is that enough to allow an employee to change their election under either cafeteria plan or health FSA? And the answer is no. It has to be a final divorce decree. So just filing isn't enough to allow individuals to change their election. Change in number of dependents. These includes birth, adoption, placement for adoption, or death. Again, in this situation, you can allow an individual to change their health FSA election and to change the amount that they're going to be contributing to the health FSA. Change in employment status. This includes termination and commencement of employment, strike or lockout, either commencement or return from unpaid leave, change in work site, change in employment status causing a change in eligibility for the plan. And that's important. And the most common situation here is somebody goes either from full-time to part-time, part-time to full-time, and because of that, their underlying coverage changes. So for example, if you go to part-time and there's no coverage or a very limited coverage, then you can allow an individual to change their health FSA election to increase it. A dependent satisfying or ceasing. Yes.
If you don't mind, I'm going to interrupt you real quick. We got a question here.
Sure.
And it's a bit lengthy, so I wanted to get to it right away.
No problem.
It says, let's see here. Under the ACA, employers under 50 EEs that are fully insured, the health plan has to provide pediatric dental. Some fully insured plans provide that as part of the medical plan, and some don't provide that as part of the medical plan. For fully insured carriers that don't provide pediatric dental, and the only way for employers to get pediatric dental is through a private individual pediatric plan. The question is, since the ACA mandate has been repealed, what is the employer's liability, assuming they are under?
Well, the individual mandate has been repealed, but not the employer mandate.
So can the employer be fined or the employee be fined? And what if an employer tells?
Well, what the employer has to do, they don't have to satisfy that requirement if they go to the employer and say, do you have pediatric care? And they say yes. And then the employer is not required to do so. If the employee says no, then they have to provide that coverage. So they don't necessarily have to provide it if the employee says to them, I already have it, don't worry.
Got it. Okay, thank you very much.
Thank you. Okay, so for dependent, satisfying or ceasing to satisfy dependent eligibility. This is because attainment of age or marriage or other similar circumstances. Now remember, if you have a health FSA that's what's called a exempted benefit, it's not subject to it's not subject to ACA. So in some situations, the definition of dependent could be different under the health FSA than it is under your other coverages. That's extremely important to understand. Now remember, in this situation, one of the other requirements, not only do you have to have an event, but the change has to be consistent. So if a change in status occurs, a plan can only permit employees to make an election change that is consistent with the event. So if, for example, if somebody gains a dependent, then the consistency requirement says, okay, in that situation, because you have one more dependent, then you would, the consistency requirement would require you to increase your, allow an employee to increase your election, not to decrease it. Under this consistency rule, the change in election is not permissible unless the eligibility for health FSA coverage has changed or certain circumstances of eligibility of the other coverage. So in that situation, gaining a dependent, you would, an employer, you would allow them to increase it, not to decrease it. So the election change must be an account and correspond with the event. If one type of coverage is lost or gained, then the employee is limited to changing the election with respect to the coverage. Other eligible individuals can also be added when the sponsor or dependent gains eligibility as a change in status event. So for example, it changed employment if a spouse gained new employment and they had their own coverage, then logically the consistency requirement would say, okay, as an employee, you could change your election and decrease how much you're contributing to the health FSA. So if an employee was not previously enrolled and a change in status occurs, this rule would allow individuals to enroll in order to enroll the dependents. So there's various things you, again, are allowed to, but remember, there's two requirements. One is that you have to have an event, and then when you make a change, the change has to be consistent with the event that has occurred. Let's look at the Cobra qualifying event. So a cafeteria plan may permit an employee to make a mid-year election change if a Cobra qualifying event occurs to the employee, spouse, or dependent. An employee may increase pre-salary reduction to cover their Cobra premiums. Most employers don't allow this, but you can. And remember, Cobra premiums, that's generally for the cafeteria plan, that's not for the health FSA. The health FSA situation would be in regard to changing or reducing the amount or increasing the amount, depending on the situation, your health FSA election. Judgments, decrees, and orders. This is very common in regard to a cafeteria plan may allow mid-year changes in account of judgment, decrees, or orders resulting in divorce, legal separation, or annulment, or change in legal status. In this situation, this involves with qualified medical child support orders, where a court has ordered an employee to cover their dependent, and because you're adding a dependent in that situation, the consistency requirement would say, okay, now what you can do, you can gain coverage, but not only that, but you can also increase your health FSA election to cover that dependent and their expenses. So that would be consistent with judgments, decrees, or orders. Entitlement to Medicare or Medicaid. So a cafeteria plan may allow mid-year election changes in account of eligibility of an employee, spouse, or dependent, or for Medicare or Medicaid. Gaining Medicare allows an employee to cancel or reduce the FSA amount. Losing Medicare or Medicaid allows an employee to elect or increase their FSA amount. So again, you have to be consistent in the event, and depending on so remember, in a Medicare situation, an employer cannot force, especially if you have 20 or more employees, an employer cannot force an employee to elect Medicare. It has to be voluntary, but again, the employee can voluntarily make a change, and they're allowed to make a change to their FSA election. Family medical leave, leaves of absence. In that situation, if somebody goes on family medical leave, cafeteria plan may allow a mid-year election change in account of the leave of absence, and the reason for that is the fact that that person, and in most situations, that leave is unpaid. And so if an employer wants to continue, and they can continue their coverage under the health FSA, but it's going to be, in most situations, it's going to be on a after-tax basis. So the plan may allow participants to revoke health coverage if so wishes. An employer can reinstate coverage after the return, but they can continue both their medical coverage and the health FSA coverage. And in most situations, that's going to be done on an after-tax basis. So if an employee continues coverage during family medical leave, an employer may allow 3 types of payment options. Either you can prepay before you go, you can pay as you go during leave, or you can, again, allow an employee to catch up and pay the employer after they come back. The problem with that is that the employer is taking it on the chin if the employee doesn't come back, and they have to chase the employee for the money. So in this situation, I remember if somebody revokes their election under the health FSA during the leave, those expenses during the leave cannot be reimbursed. But they can, again, once they come back from the leave, they can continue coverage after they come back, but those expenses during the leave cannot be paid. And then during the leave, remember, if they decide to continue coverage, they're going to be treated as an active employee, so they're going to pay the active employee rates. That's extremely important to remember. But if somebody, what's interesting, if somebody does decide to continue coverage during leave and then decides not to pay the premium during leave, technically that it's not considered to be a Cobra qualifying event. So you as an employer can terminate coverage and then wait until the leave ends to reinstate the coverage. But when that coverage lapses during the leave, the employer doesn't have to offer Cobra. So here are some other events that may cause or permit a mid-year election change. A military leave under USERRA, mistakes made by the employee or the employer, participant fails medical underwriting, which is under ACA very uncommon now. And also mid-year election changes may be required to pass non-discrimination testing, especially for the highly compensated. Any situation where there's automatic loss of coverage because of the fact of a termination. Now, one question, and there's no guidance on this, suppose you have an employee comes to you and says, I didn't really understand what a health FSA was, and I signed up for it, I don't really need it, and I want to change their election. And what I tell employers in that situation is that you have to judge when that person comes to you. If they come to you a few weeks or a few months after the beginning of the plan year, I think it's a real consideration. The employee did make a mistake, they didn't understand it, and you should allow them to change. But if the employee waits 3, 4, 5 months and comes to you, that's extremely suspicious. And as an employer, you can say, I'm sorry, you made that election, we explained it to you in a summary plan description. I'm sorry you didn't understand it, but the election as you made will stand. So again, it's up to your discretion, but remember, in this situation, you have to be consistent. You have to look at each situation separately, yes, but you have to be uniform in your decision. Now, administrative changes in regard to mid-year election changes. Remember, if somebody tells you that they're getting a divorce or they've just gotten divorced, you should get substantiation of the change. So obtain a substantiation for reasons for the change, decide when the election can be effective, and that should be in your plan documents or SPDs. Once you have communicated and you've accepted that, yes, the event did happen, then you have to be consistent on when that election changes, and that should be in your documents. Confirm the cafeteria plan and regulations do allow that change, and confirm with the plan document and insurance policies allow this change, this election. And that's very important, because one thing employers don't understand, they draft their cafeteria plan documents and don't really check the insurance policies. And the insurance policy may say in some situations, I'm sorry, we're not going to allow, especially on the cafeteria plan, not on the health FSA side, we're not going to allow an employee to change. So that will not really affect the health FSA, or more affect the underlying policies. Let's look at the carryover requirements. And this is something that came in a few years ago.
Larry, I have a quick question here.
Sure. I'm glad you interrupted me, because I was originally going to stop for questions, because we're changing over to another section. So. Okay,
perfect. This question says, if coverage lapse for the EEs curing FMLA due to non-payment, the ER does not have to offer Cobra, ?
Yes, that's true. It's not considered a Cobra qualifying event. It's only considered a Cobra qualifying event at the end of the family and medical leave. Non-payment during leave, it's not considered to be a qualifying event for Cobra purposes.
Okay, thank you so much. Appreciate it.
No problem. As I said, this came about a few years ago, I think 2013 or 14. And as it says, health FSAs are allowed to offer carryovers of unused balances of up to $500 remaining at the end of the plan year to be used for qualifying medical expenses incurred in subsequent years. One of the biggest concerns that employees have when they sign up for a health FSA is that, am I going to use all the money that I've elected? It's up to $2,650. Am I going to use all of it? Because many employees are afraid of the use it or lose it rule. This kind of is a way of alleviating partially this rule by saying, you could guess, but if you guess wrong, up to $500, we'll allow you to carry that over into the next year. But remember, this offering health FSA carryovers is optional, and is an alternative to offering a health FSA grace period, which is only for 2.5 months. So you have to decide in electing one or the other. You can't do both, or you could do neither. So health FSAs allowing carryovers from the plan year cannot also have a grace period. So you have to decide one or the other, but you have to decide to do this before the beginning of the plan year. So it's got to be amended. So since it's optional, you have to add it to your cafeteria plan or to your health FSA. So this is an exception to the use it or lose it rule, offers the potential to reduce health FSA forfeitures, which may encourage more employees to participate in the health FSAs, but also may decrease how much you as an employer receive because of the forfeiture. So it's a trade-off in there. It may make it more popular, but it may increase your risk in paying out more money. That's the problem. So again, amounts carried over are available to reimburse eligible medical expenses incurred for a subsequent year. Since offering health FSA carryover is optional, plan sponsor wishing to carry may specifically provide for carryovers in the plan document. It should also be in their SPDs to explain to the employee what the limitations are. And it must apply, same carryover provisions must apply to all participants. You can't change it according to an employee group. And the uniform coverage rule will continue to apply to health FSA that offers carryover. So again, if you carry over $500 and that person has an expense at the beginning of the year, towards the beginning of the year, then that whole $500 is available towards the beginning of the year. So again, the amount that the employee can carry over is based on the health FSA amount remaining from the plan year at the end of the run-out period for that year. So depending how long your run-out period is, and again, you have an option of not allowing any amounts to be carried over until the end of the run-out period, because you don't know how much is going to be carried over. So at that point, unused health FSA amounts from the plan year in excess of the $500 are forfeited, and the remaining amounts can be used to reimburse eligible expenses during the new plan year. So the way to categorize this is an expanded grace period, and it can be a year or 2 or 3, depending you as an employer what you want to allow. But again, that amount of $500 that's carried over is available for the entire plan year. That's extremely important to understand. So during the carryover period, a balance may be used either in the prior year or the current year claims, although no more than $500 in potential carryovers can be used to reimburse in the current year. During this time, the plan may reimburse current year plans first from the current year amounts. While the ordering rule is permissive, it appears to be the best practice. In this situation, what I'm saying, what most employers do, for current year expenses, we're going to use current year money. We're going to wait until the end of the run-out period to apply the carryover amount, because we don't know how much the carryover amount is going to be until the end of that run-out period. So you as an employer are taking a risk by allowing that carried over amount before the run-out period to determine how much it is. So I would hold the carryover amounts until the end of the run-out period to know, is that employer going to have the full $500 or something less, because we don't know until the end of the run-out period for the previous year to determine how much that amount is going to be. So using current year contributions first allows potential carryover amounts available to reimburse prior year expenses. So that's the best practice. Wait. That's the best thing. Conversely, reimbursing current year claims from potential carryover amounts during the run-out period will reduce the amount available to pay run-out claims for the prior year. And you don't want to do that. You want to make sure the full amount is available. Now, the most important thing to tell your employees is that if you do have a carryover amount, and amounts do carry over, that's going to affect, for the whole plan year, your eligibility for HSAs. So a general purpose health FSA carryover raises HSA eligibility rules similar to those presented by grace periods, but instead of only being a problem for 2.5 months, it's going to be a problem for the full plan year. So a carryover to a general purpose health FSA makes the employee ineligible to contribute to his or her HSA for the entire subsequent year, even after the carryover is exhausted, and even if the employee does not make or receive any new FSA contributions. So if that employee, for example, uses it up towards the beginning of the year, it doesn't matter. That employee is stuck for the entire plan year. And that's something to really explain to employees, that this carryover has some advantages and disadvantages. So the adverse effect can be avoided if the plan allows employees to decline or waive their carryovers prior to the beginning of the next plan year. And this is something you have to do at the open enrollment before the beginning of the new plan year. So an employee who declines or waives a general purpose health FSA carryover under the plan's terms may contribute to an HSA during the next plan year if he or she would otherwise be HSA eligible. With some other situations that an employer may do is change it, allow an employee to change it if they're going to contribute to an HSA from a general purpose to a limited purpose. And that way they're guaranteed that they're going to be eligible to contribute to an HSA. So this is something that should be explained to the employee, and you have to weigh the fact that how much discretion you're going to give to the employees. Are you going to make them decide? Are you going to allow them to decide how they're going to carry over? That's a dilemma that many employers have. Now, will carryover affect a HSA status of an accepted benefit? That's extremely important. I'll be describing in a few minutes what that means, but it does not. However, it is unclear whether carryovers may cause a health FSA to fail the availability condition, and I'll be explaining that in a few minutes. This condition or this accepted benefit is extremely important for health FSAs, and there's two conditions for it. And why it is important is the fact if most health FSAs are accepted benefits, which means it's not subject to healthcare reform. And there's some special rules that apply for that, especially with Cobra. And health FSAs, carryovers do not affect that status, but I'll be explaining that in the next few minutes. What Cobra issues are presented by a carryover? Well, in this situation, a health FSA are included when determining the benefit that the qualified beneficiary is entitled to receive. And carryovers must be counted when determining whether an account is overspent or underspent. And the last point is extremely important. There's no premium for the carryover because the employee is already spent it, or is already paid for it, excuse me. So there's no, so that employee has to be allowed, and that's an administrative issue that you have to contend with as an employer, that employee has to be allowed to use that money for the next year or whatever period that employee is entitled to use it. Can employers limit the carryover to employees who make salary reductions for the new year? Absolutely. So as this slide indicates, the 2015 guidance clarifies that carryovers can be limited to individuals who have elected to participate in the health FSAs for the next year, but you have to put that in your cafeteria plan document. They don't want employees not electing, again, to participate, and then have that money that you have to account for administratively, you have to pay for. So this plan design is permitted even if the minimum salary reduction is required for participation. So again, you can put limitations. You could put limitations on how much can be carried over. You can put limitations on the carryover period. And you can give employees elections of how they want to treat that carryover when it carries over to the next year. And that is the next slide. So the 2015 guidance allows health FSAs to require that the carryover amount be forfeited if not used within a specified period of time, such as 1 year. Now, as an employer, if you wanted to, you could do it for the entire year, for the more than 1 year, but many employers limit that period because they don't want to account for and be responsible for following this amount. And as this slide indicates, this plan design requires additional administration, track the time, limit the carryover dollars, as well as ordering rules. So it adds to the administrative expense. The longer you allow an employer to carry over that amount, the more expensive it is and the more apt that you can have mistakes in the situation. So again, balance the fact of these issues and concerns with that money being available to the employees. Can the employer establish a minimum carryover amount to avoid having to administer carryover very small amounts? Some employers may wish to establish a minimum threshold to participate in the carryover, $5 or $10. It is frequently done for health FSA elections. The carryover guidance does not indicate whether such a practice is permitted. However, an IRS official has informally commented that it would seem reasonable to have a small minimum carryover amount, such as $5, $10, or the minimum annual election amount for the health FSA. So again, the chances are pretty good you can say, I'm sorry, if your amount is $10 or less, we're not going to allow you to carry over because of the administrative expense for doing this. Are carryovers factored in the non-discrimination rules? The carryover guidance does not address whether carryover amounts must be factored into non-discrimination rules. But an IRS official has informally commented that carryover amount would not be taken into account in the non-discrimination testing for subsequent plan years, since these amounts will be considered for the year in which the original contributions were made. So what they're saying here is they cannot be counted twice. It's counted in the original year that it was contributed, and then it's forgotten. So there's no guidance on this, but that would make sense in the situation. Cobra issues. These are Cobra issues and health FSAs. So health FSAs are group health plans, and thus are subject to Cobra, unless it's maintained by a small employer, church, or federal government. So if you have less than 20 employees, then Cobra doesn't apply. So if Cobra applies to your group health plans, it also applies to your health FSA. And health FSAs that are subject to Cobra must offer Cobra coverage to qualified beneficiaries who lose their coverage as a result of qualifying event, unless the special limited Cobra obligation it must provide all required Cobra notices, including the initial notice and election notice. So an IRS representative had informally indicated that the IRS view that family members other than the covered employee are entitled to elect Cobra under a health FSA in connection with the employee's termination of employment. Now, in my experience, I've not seen an employer do this. They usually limited the health FSA to just the employee. But again, what you see in this slide, that's the official IRS guidance on this. Now, a health FSA meets certain requirements or prescribed by the IRS Cobra regulations. The obligation to offer Cobra coverage is limited. So again, Cobra coverage need not be offered to qualified beneficiaries who have overspent their accounts as the date of the qualifying event. And for those with underspent amounts, the Cobra must be offered but may be terminated at the end of the plan year in which the Cobra qualifying event occurs. So again, the 18, 29, and 36 months does not apply to most health FSAs, and it has to qualify in this situation as an exempted benefit. Now, I've been using that term. What does that term mean? This slide explains it. To qualify for a health FSA must provide exempted benefits, and the Cobra premium under the health FSA must meet two requirements. The benefits provided under the health FSA are exempted for a class of employees if the health FSA is a health FSA that satisfies one maximum benefit condition. What that says is the maximum benefit payable under the health FSA to any participant in the class for the year cannot exceed 2 times the participant's salary reduction election under the health FSA for the year, or if greater, the amount of the employee's salary reduction election for the health FSA plus $500. What does that mean in layman's language? It means that, one, if you're contributing as an employer, your contribution cannot be more than $500, or if you're doing a match, it cannot be more than 2 times the match. So if you're not contributing any money to the health FSA, you're fine, you have no problem. But if you are contributing to the health FSA as an employer, and that amount you give your employees $1,000 a year, in that situation, you would violate the first condition. Now, what that also means is the fact that health FSA now would be subject to ACA, and there's all kinds of ramifications behind that. The second condition is that other group health plans, not limited benefits that are exempted benefits, limited scope, dental, and vision, must be made available for the year to a class of participants by reason of employment. What does that mean? It means the fact that the employer must offer health coverage, and the employee has an opportunity to turn it down as long as it's offered. So you cannot, and what many employers do, They say, we don't offer any group health coverage to our part-time employees. We're going to offer the health FSA to the part-time employees. In that situation, they would be violating condition 2 of being exempted benefit. So an employee can turn down coverage, but they have to be offered coverage. So again, if you offer health FSA to a part-time employee and you never offer them other group health coverage, you would be in violation of condition 2. So again, this is a really important exception. And if you're not offering any group health coverage, you have a problem. Or if you're making employer contributions, you could have a problem. So again, under the IRS Cobra regulations, the health FSA qualifies for the special limited Cobra obligation if it satisfies the previous 2 conditions and also satisfies the third. The maximum annual Cobra premium chargeable for an employee must equal or exceed the maximum annual health FSA amount. So what that means in layman's language is the amount of the Cobra event, the Cobra premium under health FSA is whatever the employee elected for the year. That's what must be available to the employee. As I indicated before, to determine whether an account is overspent, if the account is overspent, that means you as an employer don't have to offer Cobra. So in order to determine whether the account is overspent, an employer must examine the claims activity for the specified qualified beneficiary. The determination of whether a qualified beneficiary's account for the plan year is overspent or underspent as of the date of the qualifying event depends on the elected annual limit for the qualified beneficiary for that year, the total reimbursed amount of claims submitted to the health FSA for the plan year, and the maximum amount that the health FSA is permitted to require to be paid for the Cobra qualifying event for the remainder of the year. And the remaining annual amount is the elected amount less claims. Now, the realistic and easiest way of doing this is this. If the remaining Cobra premium is more than what's remaining in the account, then it's determined to be overspent. So realistically, if somebody spent most of the money at the beginning of the year and they terminate employment, you as an employer don't have to offer them coverage because the remaining Cobra premiums for the rest of the year are more than what's available. So in that situation, you as an employer don't have to offer them Cobra. So if the remaining annual limit is less than the maximum Cobra premium that can be charged for the rest of the year, then the account is overspent. So if somebody elected, for example, $2,400 and they terminate employment July 1st. So what they're doing, they're electing $200 a month already. And then at 6 months, for the remainder of the year, they only have $800 left. Well, the remaining Cobra premium would be $1,200, and therefore you don't have to offer Cobra in that situation. A very common dilemma for most employers is the fact that they offer both a health FSA and an HRA in the same year. And the basic question again, well, how do they interact? And the basic question is, who pays first? So under Code Section 105H6 defines a self-insured medical reimbursement plan as a plan of the employer to reimburse employees for expenses for medical care for reimbursement that is not provided under a policy of accident or health care. There is an exception. It seems that the payer of last resort principle still survives as a practical matter when the employer also has an HRA, unless the HRA requires the health FSA to pay first. What does that mean in layman's language? It means by statute. It means that if you don't specify otherwise, and there's an expense, the first plan to pay is going to be the HRA unless you specify otherwise in the documents. And what you want to do in that situation, if you do sponsor a health FSA and an HRA in the same year, you want to make sure the employee can take their money out. And the health reimbursement account is just there as a reserve. You don't want your employees to lose their money because the HRA is paying first. That's what this is trying to say. So generally, if an employer participates in both a HRA and a health FSA offered by the employer, and both plans cover the same expense, the employer must first look at the HRA for reimbursement and second to the health FSA. That's what the statute says. However, the HRA plan sponsor can choose prior to the beginning of the year to require the HRA plan document and the health FSA to pay first. So again, you have to look at your documents if you're sponsoring both plans to see what they say. And you would want the health FSA to pay first because you don't want employees to lose money. So the HRA plan document and the health FSA plan document must specify that the HRA is the payer of last resort. That is, coverage under the is available only after expenses under the dollar amount of the health FSA has been paid. Christine, are there any other questions? I've been going on for a while.
You know what? Not currently.
Okay.
Yep, we're doing good.
Okay, no problem.
I'll
Okay,
let you know. Yep.
I appreciate that. Thank you.
No problem.
Okay, let's look at HSA's issues with FSAs. These are common questions. Again, if an employer adopts a high deductible plan and during the year, may an employee elect to terminate their participation under the health FSA? And the answer is no. As I explained in previously, there's changing costs and coverage is not an election under health FSAs. So the employee is stuck unless the employer amends the health FSA to be a limited purpose. So can an employee participate in either a health FSA or an HRA in the same month and still be eligible to make or receive contributions? No, unless the employee situation is one of the following. The employee's expenses reimbursed under the health FSA or HRA are limited to dental, vision, and preventive care. This is below the deductible. And then above the deductible, they can then reimburse any medical expense. The employee suspends participation in HRA for the year, suspend an HRA. The health FSA or HRA pays expenses above the deductible, as I indicated before, or the HRA pays or reimburses employees' expenses incurred after the employee retires. So again, you have to be very careful when you have a health FSA or an HRA and an HSA in the same year.
Oh, you know what, Larry? We have a question now.
Okay, no problem.
All right. We have a couple questions. All right, here is the first one. When a company has 19 FTEs at times and then 20 or 21, how do you determine which way they should comply? And we have state continuation in Colorado available too, based on the previous year's FTE count, question mark?
In this situation, part-time, depending on how many hours they work, part-time people are determined in the calculation for determining Cobra. So you look at your full-time employees and then your part-timers. If they work 20 hours and normally the full-timers work 40 hours, they're treated half the employees. All right. And then you look at, in that situation for Cobra, it's that you have 20 employees, I think for most of the year. Then for the next year, you're subject to Cobra. So you count both part-time and full-time employees, but full-time employees are only counted as a fraction depending how many hours they work. So in that situation, you have to look at how many hours those employees, those part-timers work, and then put them together. And I think it's 50%. If you have 20 or more 50% during the year, then you have to have Cobra. You have to provide Cobra the next year.
Okay, great. Thank you. All right. The next question we have here. Would you say when you say above the deductible, do you mean the plan deductible or the IRS minimums for an HSA qualified plan?
It is the deductible for under the IRS regulations. So if you have a $5,000 and $10,000 deductible, you don't have to use those. Well, let me put it another way. If you have a very high deductible, what you do, let's say you have a $5,000 deductible, and let's say for single coverage you have a $2,600 deductible, and I think the deductible this year is like $1,300. In that situation, you use the IRS deductible, so you don't have to use the plan deductible. That's what I'm trying to say. Okay.
I see. Okay, thank you. And then, you know what, going back to that prior question, so 30 hours is full time, and they still go back and forth. Do I take an average is the question.
I don't know the answer to that question. I think an average probably be the best way to do it. I have to look at the part-time guidance to give you a complete answer, but I would think an average would be good. But that's I haven't looked at the regulations and with that issue.
Okay, well, that's a great question then.
Mm-hmm.
Thank you. All right, that's all we have for questions right now. You can
Okay.
go ahead and proceed, Larry.
I appreciate it. Thank you.
No problem.
Can an employer amend its general purpose FSA for a limited purpose during the year? Absolutely. It's unofficial guidance from the service, so the employer can amend the health FSA to a limited purpose to allow employees to participate under a health FSA. Now, the question of the hour, and again, the Congress has been threatening for years to repeal ACA healthcare reform. What would it happen? Well, again, limitation on health FSA salary reductions would be pulled. I remember previously, before 2013, there was no limit. The $2,500 limit were imposed for plan years beginning in 2013. It's now $2,650. If healthcare was repealed, it would go back to what it was before. So you as an employer would actually determine how much your employees would contribute for a year. So this limit applies on a plan year basis. The limit only applies to salary reduction contributions, and it applies separately the limit to each employer. There are restrictions on over-the-counter drugs. Remember previously to 2010, and a health FSA could reimburse over-the-counter drugs. If healthcare reform was repealed, over-the-counter drugs would again be reimbursable. And many people loaded up on aspirin and all kinds of over-the-counter drugs in December if your plan year ended in December 31st. Now remember, for healthcare plans to avoid the requirements of healthcare reform, they must meet the requirements of an accepted benefit. Freestanding health FSAs are still possible if reimbursing accepted benefits. What requirements would apply if the health FSA is an accepted benefit? You would have to offer unlimited preventive care. And as you remember, for the conditions, I'll repeat them again, to be an accepted benefit are those two conditions. Maximum benefit condition, which means limited employer contributions, and two, you have to make available health coverage. The employee doesn't have to take it. Last thing, we're running out of time very quickly, how to deal with mistakes. First of all, reimbursed claims should not have been paid, error found before the beginning of the year. Basically, the IRS guidance provides that if the above correction steps have been unsuccessful, in other words, you have to get the money back from the employee. So the plan manager should follow debit care correction procedures and the attempt to correct the error by seeking reimbursement from the participant, withholding the improper reimbursement amounts from the participant's pay, or offsetting the improper reimbursement against other valid claims. If the correction steps are not successful, the improper payment should be treated as any other business indebtedness, which means it would be included in the employee's income. When this step is applied, the employer must first request payment consistent with the collection procedures. If the payment is not recovered, it would generally be treated as a forgiven debt and therefore treated as wages under a Form W-2. If reimbursed claims should not have been paid, error found after the year-end, IRS guidance indicates that under these circumstances, the mistaken payment should be treated as a business indebtedness, which if forgiven must be included in income. And the employer at all times can seek repayment of any indebtedness from the employee on an after-tax basis. Denied claim that should have been paid, error found before the beginning of the year. If a denied claim is later determined to be eligible and the run-up period is unended, the participant should be reimbursed. If a denied FSA reimbursement claim should have been paid, similar to a situation in which the employer withholds excessive cafeteria plan deductions. In both cases, and again, if you have not paid a claim, the employer is contractually obligated to make the participant whole. Let's see here. Upon discovering the error, the employer should reimburse the participant for a valid claim. The claim should be resubmitted if necessary. The amount to be paid would be lesser the full amount of the claim or the balance available in his account balance. Denied claim that should have been paid, error found after the run-out period ends. In that situation, as this slide indicates, the employer is still under an obligation to pay the claim. Where claims are paid from general assets, most employers will allow pre-tax reimbursements of previous incorrect denied claim, either because of informal plan provisions or exceptions. Some employers correct these errors by reimbursing the claims on a taxable basis to offset any lost tax benefits. Some employers will then do a tax gross-up, and the amount that would be available would be the lesser of the full amount or the balance that would have been available under the claim had been paid before the funds were forfeited. If a reimbursement is grossed up for taxes, it would include the participant's share of FICA taxes, the amount of any federal or state taxes. Are there any questions? I ended right on time.
Nope, no further questions.
Everyone, I appreciate it. Next month, we're going to have a recent development seminar. So we're going to be talking about what's happened over the last few months. If you have, again, look out for that, and we'll be doing it sometime in late July. You'll be notified of the date, okay?
Thank you so much, Larry.
Take care. Bye-bye.
Take care. Bye now.